But you and I both know the real reasons that they've orchestrated this collapse, and a collapse absolutely is due. And they might play nation state of nation state. It's a great proxy to have another profitable war, or to justify some, soldier culling, yellow man versus white, if it's America, versus China on account of a hack, or, we know the way this goes once they do it. We don't want to get sucked into and have the financial matter masked by whatever contrived geopolitical event they'll make, that they'll throw all the coverage on. It's almost great that I don't have a TV, because I'll just be watching the market.
Echo 64, home of alternative economics and contrarian views. So this is the third in the series, of Christmas interviews, Christmas special, holiday special, if you want to call it. And the second one was with Simon Hunt. This one is with Francis Hunt, aka the Market Sniper. Francis, welcome to the channel again. How are you?
Really glad to be with you again, Mario, and thank you for inviting me.
Francis, before we begin, I just want to share with the viewers where they can find your content. You've got the Market Sniper here on YouTube. I recommend, you watch. Francis has got a lot of nice content, and also if you lean more towards trading, he could be of help. themarketsniper.com. So Francis, with that, I wanted to start with because you are a technical analyst, not just a technical analyst, but that's your forte, I would say, even though I would say you have a lot of fortes. But you were right on with your analysis of the 10-year yield in the last couple of years. There's a big, I think it was you looked at the TLT, and there's a big head and shoulder, and you got that spot on. So before we move on to our favorite metals here, gold and silver, I think we should look at the 10-year yield, because that is at the base of the whole system. Just above gold and silver, but it affects the stock markets, bond markets, everything. So should we start with that then?
Oh, 100%, Mario. You're the boss, and I'm happy to start wherever you like. It's your show. 10-year yield it is. And what I'll do is I'll just get the share screen up so that everyone can join us for the journey, and look at the footprints in the sand, as we like to say, because that is essentially what a chart is all about. So yes, 10-year yield. Well, Mario, thank you for paying credence to us. We appreciate that. We were very early on the yield climbing narrative and the turn, which was part and parcel of the mega collapse in yield and the eventual subsequent spike in yield that followed. You typically end a macro bull market with a final blow off, or in the case of yields, a final capitulation, which was super bonds. They were, they were worth so much. The recent target that we had suggested would happen was a 5% run, and that it would be a technically very significant point. You can see a chart with a lot of lines on it, but I'll just, for the simplicity's sake, give the general technical pattern that we were trading in here. Quite simple, it's not actually rocket science. Once you accept the validity of patterns, you tend to get an insight that fundamentalists don't always get, because they don't have the timing of things, but they do understand that things can't exist. So there was a bit of a neckline there at around 4%. So the key round numbers. It's important to point out, Mario, and debt, just like many other markets, the round numbers are pegging levels because of the derivative markets. In other words, puts, options, and calls are all based on key round numbers generally, and they'll be the most liquid and the most voluminous generally. So this was a 5% call. We actually called for 4.9 and said you'd get a 5% run, and there it is done. Since then, it's almost as if, peak pivots, rates have been coming back. Now, I wanted to get this explanation out really early on bonds, but I think it's a simple way. It's bonds made simple for people who don't tend to watch bonds. And I think that's important. And people don't watch bonds because it's not like the equity markets. They understand equities. People understand businesses. They buy a burger from McDonald's. They get a Coke from Coca-Cola. They buy a device from Apple. But bonds are like weird. What are they? Well, it's basically a packaged block of money And I talk about you don't have a human in the moonlight without having a shadow. In the same way that you could borrow money into existence, the banking cartel has this power. You also borrow a liability and a debt instrument. So when you borrow to buy a house, that money is being created and a liability is being created with it. Whilst when you hold a gold bar, that is the entire money in your hands. It's physical. There's no T-bill accounting that goes with it. You hold the gold bar, it's yours. Borrow money for a house, they own that house technically. While it's being cast in your name, they hold a security over it, and you have a liability that you owe to them. So money's borrowed into existence, and when you have rates climbing, most people only talk about the one side of the seesaw. So the key simplicity for bonds understanding is, in actual fact, the inverse relationship between rates and valuation of the debt. So if you think of a fulcrum, and I lay my arm across that fulcrum, and that is valuation, and the hand is rates. When you have an increase in rates, my hand, there is a decrease in valuation. When you have a cut in rates, the hand goes down, the elbow goes up. You need to visualize this as a seesaw as well. It is obviously a leverage seesaw, and it's in percentage. It's almost like a logarithmic seesaw, but just, I don't want to overcomplicate this for the lay person. So when everybody is saying the economy is so weak, rates should be cut, what they're actually saying is the economy is so weak, this proliferation of debt that is coming down the tube that is ever huger should be going up in value. But nobody ever talks about that. The central bankers talk only about the rates and the economy as if they are the full controllers. So there's a couple of key points I really need to get out. So people only talk about the one side, the rates and the economy, but actually there's a debt market associated with that, with valuations. So when you have the super proliferation, 1 trillion in new borrowing probably required this year in the States, plus a massive fall in income because of tax takes going down, corporate tax takes, personal tax takes, all going down. And then they have to borrow up to make up the shortfall, greater welfare claims, greater unemployment claims, greater everything. So the government is the buffer when things are really, really bad. And you should have 7 days of feast where you put away in silos for the 7 years or 7 years of feast. You should put away in the silos, to get biblical, for the 7 years of famine. But what's actually happened is we've had 7 years of feast and we've still eaten everything and borrowed food from other tribes we need to buy back. And now the famine is coming and the tribes that we borrowed from are also facing the famine, and we have to give them their money first or they cut our heads off. So you are not only short your food, you actually short your food and the food you owe to others at the worst possible time. That is kind of a simple parable, if you would like, of where we're at. So when people are saying we need rates right down, the housing market's got too expensive, it's falling, etc., what you're actually saying is this proliferation of debt that is coming at an ever faster parabolic rate has to go up in value. And people think it's all down to the Fed or the central bank in control to set those rates. And generally, in normal economics, it is. They are trusted and they do it. What tends to happen is when the market diverges from the central bank's opinion, and then they take that power away from central banks, and that has and will happen again. And it's happened, for example, in the UK. I used the George Soros case. The British Bank of England came out and raised rates twice in a single day. They didn't have a morning cup of coffee and get a jolt of caffeine and say, damn, we had a terrible idea this morning, we didn't do it enough, let's do it again. They were forced to do that because the market took it away from them. In other words, everyone was selling British debt and selling the pound to get out, and they were in clear trouble. And as a result of that, they had to move to stop, A, the speculators, make it more expensive for them, raise the interest rates for people to borrow to short them, B, provide more incentive for people to hold British bonds, bring international money back into the country to buy bonds, and also thereby buying pounds. Again, the bond and the pound, the human and the shadow, they go together. When the spotlight's on, you will always have the one. So in essence, this is why we've also been getting the Bank of England recently saying, and there was an article I was highlighting, and the Fed saying people are over expecting substantial cuts, the rates can still go higher because they know the debt needs devaluation, and there's an absolute huge pipe that has just got ever wider with an even bigger pump throwing the product debt down ever faster. How can it escalate in value when the proliferation is about to go through the moon? I use the example, if everyone's buying Bugattis, they're not going to be 10 million euro a piece. If you have a green one for Monday and a blue one for Wednesday, and I do too, guess what? There's a proliferation of them. It's not very special to have, and an absolute splurge by volume means actually a reduction in actual true value. So scarcity is part of the gold. The fact you have to do all that work, dig such deep holes, 2 miles deep here in South Africa, crush so much rock, bring it to the surface and refine it to get trace elements of gold in an ever-reducing ore makes it scarce and of high value. Bonds is exactly the opposite. You can have all you want. You want more, you want 10 times more, we've got it for you. I use the excuse of someone playing a prank on you and getting an industrial factory to pour marshmallows through your window, your chimney, and your door until actually you can't move. You're wading through, you can't see your walls, and people say, how much more money will you pay for another load of marshmallows? At the moment, you're like, I'm done with marshmallows. I'll pay you to take them away. And this is the non-scarcity proliferation thing. You don't want to eat one. You're sick. You've had enough. Everybody's eaten all they can, and more are just pouring in, and they can't get into bed. It's just a big marshmallow land. So that is kind of where bonds are the new marshmallows, and gold is the new proof of work. Only it's the old proof of work that Bitcoin was based on. Hence why they call it mining and proof of work. It took energy, it took effort, it took industrialization. So when we talk about this, that is why these central bankers, they are establishing alibi, in my opinion, for saying, well, we told you so, when the rates actually spike in a disorderly fashion, and they all have to rush and force upwards rates in lieu of collapsing debt valuations, because all the central banks, the institutions, and the smart people now know the game is up for debt. So they're trying to think, how many sheeple and retail market clowns can we push into this? And they're going to start giving you teaser rates on interest and everything to get you to put your money into debts in big saving accounts, money market accounts, etc., etc. And that is exactly the time and the thing not to do right now. Physical is king, and you will have more likely an interest rate spike on the need for the devaluation of the debt instrument in lieu of the fact that they brought the inflation down, supposedly on the facts. Now, the inflation rate serves the purpose of actually devaluing that debt. So the fact that you've actually brought the rate of inflation, if you believe it's only 2%, the debt is only devaluing at 2%, but they're adding to it at a much, much higher rate. So this is the big debt. And you're so right by saying, Francis, I want you to start in debt markets, because now I've got to lay this picture down, and hopefully everybody will then understand the value of the physical things.
Yes, and you said that the cyclical bull market in bonds ended with like a big collapse of yields back in 2020, down to like 30 basis points in the 10-year. And most people now still are of the opinion, a lot of the bond bulls, that bull market is going to go on forever. And I think I always remember thinking, this bull market is long in the tooth, and we've got so much debt, and yet people keep buying it. And like you said, about the marshmallow, it's the law of supply and demand. The more supply you get, the more worthless something should be against something that doesn't like expand in value, let's say like gold. And it seems like normality is coming back to the bond market, and that they're not going to get away now with borrowing so much, and the law of supply and demand is going to reinstate itself.
Absolutely concur. There's nothing in what you just said that I can even find to argue with. And it's a great summary of what I was saying. That doesn't mean, by the way, that ends the party very quickly. The minute we actually start to see it very quickly, you're going to have defaults. It's not like an interest rate spike, we can stomach it. If we got a spike and it would be disorderly. The one of the key things that in a way insulates them is that they've synchronized the rest of the global economic village into the same leper colony. So there is no relative valuation play to be had, apart, I would say, from the Japanese, who attempted yield curve control and have even lower rates. So the yen is a short, and we've been calling that, and the major Japanese equities that sell more offshore and have yen-based costs, apart from their commodities, which they generally don't have, are actually going to be very profitable because they managed to compete in a very yen-strong era in the 70s, 80s, all the way into the 90s until the yen became the whipping boy. But since it's lost 30%, their domestic cost and employment certainly will have gone down 30%, and they've got a 30% bonus on their dollar euro-based earnings, selling Toyotas, selling Hondas, selling Fujitsu items here, there, Panasonic, whatever. So they are an outlier. They're just really, really bad. And they need to get the interest rates roughly in line with most of the others so that there isn't that relativity assessment. But generally, the whole globe is synchronized in this way. And I think the minute we start getting an interest rate spike beyond control in any one of the markets, and it could be the Japanese that starts first, they might allow one level of national contagion to go on there. But generally, once it starts trickling into the Far East or others, we're going to have our banking hack, our narrative, our geopolitical play come to the fore that will be presented as the reason for and why the bankers aren't to blame, because this happened, because pandemic, because, you know, subprime, because whatever, and remain focused on the financials. That doesn't mean I don't feel the pain and the anger for wasteful human life being expended on fake narrative, but what can you do? At our level, what can you do? You have to preserve your own sovereignty, do what's right so that you can still help people remain strong, which means financially strong, secure, and self-reliant. Saving people on the other side of the planet, it's kind of a bit beyond me until I get that Iron Man disc here in my sternum, and then I'll start zipping around the planet and helping others in that sense.
Yeah, I agree with you. And I think it was Sun Tzu, the Chinese philosopher, who said, you first need to know yourself, then you need to know your enemy, and then you might be able to win the battle. And I think this battle, we can win it for ourselves, our family, our families, our communities, but we can't try to beat our enemy because he's a lot stronger. So I'm not saying I'm giving up, but we need to be clever and know what they're doing so we can benefit from it. And I wanted to ask you, could you show the TLT
100%.
head and shoulder, because that was a really good catch there, so people will have a better idea. This is the price. TLT is like an ETF that matches like a maturity of 20-year treasuries.
Long term, yeah. It's a hybrid long term. It's got 20, 30s, and a lot of.
I thought that was a really good chart that you had, that you could call, you know, when they broke the neckline. And then after we look at that, maybe tell us what you think now. If this, I personally think what we're seeing is a correction. You know, and you sell the rally in terms of price. You know, that's how I see it. And do you think we could go further up, or are we almost near the top here as well?
Yeah, great questions. And again, thank you for crediting us for a call that we did get right. We're not right on everything.
Yeah, I know. Yeah, the same here.
This particular event, just ref that call. Many people were calling bonds even stronger. And you may recall there was almost, I consider it the NERP PSYOP, where people would technically even pay to have government debt. I remember how convincing and how much effort they were putting into that. That was a great bit of what I call to reap confusion and chaos in people's minds, where you invert a reality entirely. Never do you lend money and then they get to charge you for the privilege of lending money. But they actually got a lot of people in on that. The Swiss did 100, was it the Austrians or the Swiss? It might have been Austria that got 100-year debt away for
Yeah,
next
it was Austria. Yeah,
yeah. Next to 0%. Now, those things have lost in capital value. It must be right now. I would hate to know. I think 35, but somewhere between 30 and 40% in value.
Yeah,
So they
probably even
pay,
more.
yeah,
And
and
Francis, the other thing is, I think it was in early 2021 or 2020, there was $17 trillion of government bonds that were yielding negative. So, like you said, people were lending money and paying the borrower, which is completely crazy.
I know, and I mean they actually managed to get that right and sustain it. Such was there's no safe place for me to put my money. This is hold on, while you can have gold, and they convinced everybody that there was no inflation. Meanwhile, people don't understand there's many different forms of inflation, and first and foremost, in the post Greenspan Goldilocks economy, you got a chronic asset inflation. Everybody just thinks simply because they were taught this in school. Inflation is your price of milk and your bread in the local supermarket or cafe going up. No, that's one of the symptoms of fiat proliferation. Fiat proliferation is inflation. It is inflating the money supply. That's where the word inflation comes from. Inflating, blowing a balloon up. And that's why we use the bubble and balloon and everything. So they were inflating the money supply, but they don't like that. They don't like to be heard. So they said, well, it's paying more for your bread and milk at the local grocery store. No, that's one of the aspects of it. But before that, if you have this open world workshop where you had globalization, you actually had a downward pressure on consumer items like TVs and everything else, and footballs stitched up by 6-year-olds in India. You could buy Nike shoes and everything with child labor in places where you didn't have to comply with decency and labor law because that nation state hadn't instituted it yet, and they were just happy to have any kind of income. And you know, we could hide our morals and have this very heavy downward pressure on inflation. And now we bifurcate the planet and we reverse all that and we bring all that workshop back. And during that period, we pump a huge asset inflation. And then after the last event, we started to get the final stage, which is actually consumer commoditized products. Commoditization means something that is generically easily producible. There's very little price elasticity. It's done in bulk. And, you know, it doesn't matter whether you farmer brown or farmer green. If you're doing wheat, you don't get much more than a quarter of a cent more for your bushel over anybody else. In other words, the commoditization is in a very moderate, low profit business implication and a very standardized output, which is very common. So those are the last things to move because there's nothing that makes them unique. Wheat is wheat. It's done en masse by massive farms. It's industrially scaled. And of course, the supermarket chain are the mafia that actually take all the profit out of the product. Very little goes to the farmer, which is exactly how they want it because the people that are running this game never have been farmers, but they have been collectivist, Bolshevik, fascists, and communists. And so they establish a network which turns the screws on production, and they assumed the power, and they were allowed to do this without government protection, and farmers went unprotected, and supermarkets were given proxies and economies of scale and various other things that they became the dominant force. So that's kind of where we are. By the time you start seeing commoditized goods, your bread and your milk going up in cost, you know that all other inflations have already happened because it's the last place where it'll occur. You know, it is, again, as I sometimes say, it's the 2 tankers full of pink colored Crocs that were all mass printed long after the fad was over. You know, you don't pay more than $5 for them if you pay anything at all. They are bulk sale and they're found by street vendors everywhere in massive discount basement sales, and they can't move them, and you've got to be the cheapest, otherwise they don't sell. It is a simple, that is a commoditization. And so it is the last place where the inflation shows. Anyway, to get back to your TLT question after that sidebar, many people were expecting this to go up and were saying, buy bonds, you know, wear diamonds. And we were saying, buy bonds, wear coal. And in the end, I actually take that back. I consider coal a far superior investment in actual fact. I apologize to coal for putting it in the same category as the debt instrument. But, that slur on the general commodity that is energy producing aside, this was a head and shoulders that we projected would probably occur. And we expected the spill down to this level and then a rally. It did actually rally more than I thought. I remember when I was saying, well, we could be wrong, but let's stick to our story. Very quickly came back down, and then you ran this target, and then you had a sustained period in the 100 to 108, which is a key psychological level here, which you then rising wedge and you put in a deeper spill. And then your question comes, is this just a rally or is this a bottom? And cyclical macro head and shoulders, Mario, technically, they not only make their targets, but they are often real big, what I would call oil tanker having done the 180 degree. They take a while to turn, but when they turn, they don't just go for a mile in the opposite direction. Just completing the turn, you've traveled 6 miles. And once they've turned, they're crossing the Atlantic. So they tend to be secular trends. So this falls more in the category of rallies to be sold than bottoms to be bought, to answer your question. And especially in lieu of that potential spike. But when the spike and the supreme momentum comes, I expect them to stop the movie. It's almost like when I was at boarding school and we used to get movies and it was a Catholic school and then the dirty scene was coming. The brothers would rush to turn the projector off and we would be going, oh, come on. It's kind of like that. They'll stop the game at the sexy bits where you get to make the real biz, and you get an absolute thriller, an absolute spiller all the way down. And they'll be like, no, speculators are crashing the market, or this banker, and they'll try
do
project.
you think they would close the bond markets? Is that what you mean, or
I think we'll go into the yes. When you say close the bond markets, I think it won't just be the bond markets, because what you've got to remember is it's kind of like closing the shadow markets. Well, that means if I'm taking the shadow away, I'm also killing Mario who's standing in the spotlight. So the currency markets will be affected, the money system. There's so many angles to it. This will, of course, lead to bank failure. So when you're talking about these things, bonds immediately means currency, because there'll be a relative country that's worse off. Currency will start to become worthless. Inflation numbers will suddenly, out of nowhere, appear to spike at the same time as the debt is collapsing. And you very quickly get into a hyper situation. They won't necessarily want to see it play all the way out to Weimar Republic. And there won't be the same degree of cash notes, because much less of our money is actually cash notes. Most of it is digits in a computer. So that's why the computer hack narrative, China did it, North Korea did it, Russia did it, villain of the moment that we plan to blame, pulled it in, will be a false flag event. But that's how I imagine, in my best on balance of probability guess, your accounts got zeroed. This happened. These people want to upset us. They hate our way of life. They hate our democracy. We need to go to war. They've crushed our system. Don't worry, we're going to get them for you. Channel the hate at Russian, China, North Korea, whatever, and say, we're on it. We're going to wage war. A war you don't want, a destruction of your money you didn't want, and a misdirection, a la the standard cartels modus operandi of practice.
Yeah, and no one will, well, a lot of people will know, like you and I and the viewers, but the powers that be will say, yeah, they will never talk about the fact that the debt was, abused, and the fiat currency was abused, and that's why everything collapsed. But I remember in the early 80s, I used to think, I was still young, that it was the rising price of oil that caused inflation. But as I've grown older, I realized that it wasn't. It was all the money printing they did for the Vietnam War that eventually led to that. So maybe you could explain to the viewers, because a lot of people will probably be saying, well, what if the Fed cuts rates and starts doing QE again? Won't that bring the bond market back into a bull market?
If it was only the power that only the Fed had, what you need when you cut the rates is, I would just refer you back to the seesaw of rates going down, valuations must go up. For valuations must go up, somebody needs to be taking all the offer of debt, which is getting fatter, thicker, and more, and buying not only everything that's offered, but so hungry to buy the marshmallows in a house full of marshmallows, a toilet full of marshmallows, a bath full of marshmallows, that they say, more marshmallows, please. They're going to run the stack so that the rates can cut. Because as I push the rates down, my hand, you can see my elbows pointing up. So you're going to come and buy more marshmallows in a house stuffed with marshmallows. Everything is sticky. Everything is everywhere. All your plates are filled with it. You're going to say, more, please. So the question is, who's the idiot? And the problem is, no other nation state that is going to be looking to maintain its wealth. You've got to remember, China's been stacking gold and physical things. They're not in the business of doing, whilst they've become part of the leper with the debt scenario, they also are, they are interested in certain prudent financial systems and not being bag holders for the Americans. Their debt holdings are dropping, A, in valuation, A, and B, by not purchasing anymore. Surprise, surprise, proxy Britain and Japan suddenly became buyers, who are all essentially part of the same cartel. I refer people to our Prof. Werner interview, where he highlighted how the Bank of Japan is actually under the control of the Federal Reserve since the end of World War II. And they would and need to comply. So suddenly the two compliant nations, one ceded America through Freemasonry and has had covert control through America, the United Kingdom, and is holding the whole game together, for which America is the big aircraft carrier for this sort of Zionist game of borrow and lend until existence, crash everything, and then introduce this global technological fascism and communism for the masses, and run through a corporate fascist cartel. But so with that being done, the two friendly nations are doing, we're doing some buying of debt, but otherwise the Fed is going to be the primary monetizer. Now the Fed, in terms of its own balance sheet, is on literally on an inverted pyramid of a pin of itself as well, and is having, and you've got the interest rates are so high. And who's the recipient of that interest rates payments? Well, it's the bankers on the debt. So the American citizens are deemed to have borrowed money because their proxy of the government has done that. It's borrowed more money than they're getting in an income, given it to Israel, given it to Ukraine, and various other causes, cutting what it's paying to its vets that fought war, being really tight and fiscal and austere in terms of what it aims to pay in future, letting more immigrants in to further load the welfare bill, the unemployment bill, and all the rights that a new American will get coming through a border. Intentionally, all these policies are designed to force financial capitulation. So there is an intention. I mean, you grab the controls of the plane and you push them forward, and you head for that mountain. This is the management. There is nothing random. There is nothing even believable about this being constructive policy. It is inherently destructive, and there are a certain group of people that pride themselves on embedding themselves in a society and being inherently destructive, seizing the control, the parasite within the locust that has a jump over the edge of the cliff. It literally is a proxy control, and they want to bring in, via BlackRock, a tokenization system which will see every asset that you buy having a proxy derivative tool that will be based on a blockchain, or if HBAR gets its way, on whatever platform it is going to be called, whereby anybody can buy your token and essentially own that asset. And then you become an automatic tenant of that asset and pay whatever the pre-agreed rental for your new e-bike, for your new house, for your new anything. So this is how they easily flip everybody's assets into their control, and everybody is turned into tenants and a rentier society on everything that they utilize on a per usage basis. And these things will be wrapped up in NFTs or tokens that will be in the blockchain. Everybody will be able to view, and they're very, very proud about, so that we know everybody who is doing what and who owns what and is identified, and everybody will have their unique ID. So this is a global system. And they say, but you're going to be escaping the borders of government. No, you're not escaping borders of government. Nationalization is actually your defense against other nation states or bigger people, bigger corporations bullying you. Once they remove the national boundaries and you have a unique ID that is uniquely global, you are now in a new world order system, and people in other countries can see that Francis Hunt owns such and such property, that motorcycle, that car, etc., etc. And I am open to total exposure of what I own, how much it's worth, and how long I've had it, and it will have its embedded ingredients that people that can print up the tokens, essentially create their own money, can purchase it off me. And it is a forced sale situation. And I would have to go buy it back for an ever higher price if I want to hold it. Only they have the power to just raise more tokens to purchase that item. So imagine I own Monopoly money, but it's treated as real, and I can buy 10 games of Monopoly, and there's $1,000 notes and $1 million notes, and I can hand you this Monopoly money and say, Mario, I own your house, you're now my tenant. And here's the embedded rental agreement. So tokenization through BlackRock and its CEO Fink bragging about what an amazing thing and how excited he is about tokenization and it will transcend national boundaries is actually selling you it's a cunning shtick and spiel for new world order. And we will know everybody, he says, we'll all know who's doing what. There won't be any, nobody can do anything nefarious. No one can defraud you. No one can steal for you because everybody who's an actor will be personally identified. In the name of keeping you safe, we will have an utter surveillance financial system that is entire planetary. That sounds like a new world order surveillance finance system to me. I don't know what it sounds like to you. And they are the creators of the people that are hacking MetaMask, etc. They are behind FTX that stole so many people's crypto. They were intricately involved. They are the arsonist and the fire insurance salesman and the fireman itself, choosing which fires they elect to put out. And then they sell you into, well, you can move into our neck of the woods where there are no fires and everybody is known and named and everything, and you have your own prison cell and we don't allow matches. It doesn't sound that great to me at all.
Yeah, that's a good way of putting it. No privacy. And it's interesting because I used to, when I worked in finance, we had one of my colleagues had clients from Norway, very wealthy individuals. And in Norway, apparently, all your tax returns, all the money you earn, all the tax you pay is all public information. So it looks like Norway is probably at the forefront of this New World Order as well. And what about the Fed? Do you think they will, I guess if they come to the rescue of the bond market and print another 10 trillion, then the dollar's finished. But either way, the dollar's finished because if interest rates spike, the dollar's finished. And I'm hearing now more and more that in the last few days that the central bankers, because we have the Fed meeting today and tomorrow, and then the ECB and the Bank of England the next day. And I'm seeing in like the mainstream press that the central bankers want to dispel this notion that they're going to start cutting rates. So it seems to me that they might not come to the rescue this time. Just wanted to see what you think about that, and then we can move into gold and silver, which I think will be instrumental, of course, just physical in your possession or with a very safe depository will be instrumental in this new, brave new world of no privacy and tokenization.
Yeah. A quick comment on one of the things you just said before I address the rest of your question. You mentioned Norway. So Scandinavia have often been the testing ground for pretty smart upmarket people, very highly socialized in terms of the welfare state, so highly accepting of this as a tendency, and also trained to accept draconianly high tax rates for that. So they've often been a testing ground for technology and this level of transparency. Where China is the testing ground for draconian social scoring and totalitarianism, absolute bulliedom. So we're seeing little bits of the total system. Remember, these guys never do something out the blue. they start testing aspects of it in certain places. And Scandinavian nations, Norway, for example, sparse, not a huge population. You're not going to get a lot of people rioting and burning houses down generally in Norway, in dense urban areas. You can inflict this and you can say, well, there's big distances, technology is the way, etc., etc. So these tests are further proof of the direction we're going. The example you gave is very telling, and we're all going to have to become Norwegians in terms of everybody knowing our stuff and prying and snooping and, oh, I didn't know you made that much, Mario or Francis, and wow, you seem to have a lot of motorcycles, Francis. That's not really fair. I only have one, et cetera, or houses or whatever you choose. And then China on the totalitarian side. The other thing you mentioned was the bankers on rates, and I'll just refer you to basically our opening statement about that. The reason they're saying that you're not going to get bailed out is because they can't. The markets will take it away from them, because in actual fact they need the debt to devalue because of its proliferation. And as per, again, the seesaw, devaluation of debts is actually a rate spike, and it isn't orderly. It's disorderly. We took 40 years of upside escalator. That literally was the stairway to heaven. And now you're doing the bungee cord down out of the heavens back to earth. You know, you don't go, you jump down the elevator shaft. Markets never go down in the same way they go up, particularly when you've hyper escalated an absolute bubble. There is only truly one big bubble, guys. Everyone will go, oh, isn't gold a bubble or Bitcoin a bubble or this a bubble? There is, by all measures, there is one gigantic only sole bubble. Everything else is minute. This is Jupiter next to a football. And that is the creation of money, which is debt and currency. And they are together. The bubble is debt and currency. That is why we have quadrillion-sized markets. It's because of money being borrowed into existence and clever proxy, and derivatives are the original proxy, by the way. They are like tokenization in crypto. They are the original proxy for the underlying market. But you see what they did with derivatives is they actually made the bigger market the derivative market, and the main game. It's a bit like the cockfighting. You know, Mario, you bring your cock to fight down at St. Albans pub there where I used to stay, called you know, the cockfighting pub there on the river, and I bring a duck. And you know what? Everybody thinks I'm stupid, but then the mafia show up and they start betting on my duck, and they're betting in the derivative markets. And next thing you know, the duck actually, you know, wins the fight somehow. This is how the game works. And the cockfighting between my duck and your prize fighter fighting cock, actually, you know, you and I had a prize of £100 wager between the two of us. But with the grandstand around it and the mafia and all the derivatives, the betting syndicates are betting tens of millions on the outcome. And everybody's wondering why everyone's betting on Francis's duck. Is there something they don't know? And the duck ends up winning and the mafia makes all the money and everybody else is absolutely aghast. So that is the derivative market, who ensure that my duck has a few tricks up its sleeve and your cock was poisoned. So that's how the game ends up. That's called a rig. And the rig system of proxy of derivative markets, the tokenization of assets, is how they digitize ownership of something that they never even need to see, but that forces you into paying them rental to utilize. Even something that you've paid for yourself. So it's an incredibly powerful tool to create a globalized grid that is transnational, where one group of people that are no longer nation state bounds, they've been parasitic across many countries, they've typically pursued this activity, finally get their goal of reducing everyone to slavery because they control the issuance of money, which will be the CBDC of choice. And initially there'll be one or two by nation. And then eventually they will be able to control the issuance of that and gobble up all the tokens. And you won't find out until you realize that that's owned by that company, that's owned by that company, but that's going to Vanguard, that's going to BlackRock, and that company is owned by State Street, and all those mega corps are owned by, you know, the City of London families, and you suddenly realize that one group of people have owned all the chips and the monopoly game is over and everyone else is paying rent to them. And that is your eventual slavery. It's a financial slavery. And there will be other tricks that are even more concerning about population numbers that we probably need to think about.
Yeah, and the derivatives as well. In the past, It started with agricultural commodities, and it was something good. It was to hedge, the farmer or the producers, they could hedge the underlying market, but it's become so big that it's like the tail wagging the dog now, the derivatives. It's controlling the underlying market. And I would say the city of London has been a huge place for derivatives. I mean, a lot of people think it's New York, but it's not. All the derivatives, most of it go through here. So maybe we could move on to the technicals in gold and silver, especially. It's going to be special to look at it right now, seeing that we saw a new high recently, and then we came back down for gold.
Yes, and I want to frame this for a lot of people. So many people saw, man, that's bad. It's really bad. And what tends to happen is people get caught up on the price action of the moment. They get caught up on the price action of the moment. This is your gold chart. As you can see, I've got tripwires everywhere for the alerts. But I want to highlight that this was a seminal moment. And technically, we have a theory that absolutely explains this, that continues to play out on an ongoing basis with regards to how and why this happened. So it was quite clear that the 2000 level was a very, very key level. And I think before on your channel, Mario, I've made the same point about the 1000 level, which was the last roughly 4-digit number that was super, super, super relevant. I'm on a weekly time frame, but on a monthly time frame, we never really closed above 2000. And in actual fact, the end of November was the first ever weekly close above 2000. And that is seminal. And what tends to happen with breakouts is the following. You get resistance, it gets respected as a level. There, sells off, there, sells off. You get clear evidence that this is a level that is going to take some taking. In other words, the allies are advancing, but you're having the battle of the bolts. They've really dug a line, and they've dug themselves in properly here, and they're going to be resisting. And what you actually had was a break of the lines for a while, first time, that got repelled in the end, and quite violently, but is the first in a stage of making further advancements. So we talk in our theory on HVF method in our learning environment and implementing the trading. And when I say trading, we're not day traders. We're not getting in and out in a single day or even a single week. We have most of our stuff we do is on the macro. So it's investing, but mild leverage, occasional long-term trades are placed that allow you to still be free and go away. Stops and targets are put in. Literally, you could fall dead and your trade position will be closed at one or the other. So it doesn't take 9 screens and all of that. I'm on just a laptop here. But what typically happens in the 5 stages of a breakout is you acknowledge the level 3 times, which has happened once, twice, 3 times. Then you break that level, and we refer to this as the break and feign back stage. So it's like you and your brother when you were young, and your brother sort of drew a line in the sand with his foot and said, "Don't you cross that line." And you stood there and you were looking at him, and you were a bit antagonized by his belligerence, and you lifted your foot up and you just touched on the other side of the line to see, kind of like, so what you going to do now? And of course, he kicked out at your leg and you pulled it straight back. But that was the beginning of you not showing intimidation of the level and actually making a mark on his side of the line. And that's essentially what happened. So there was a selling stack that was deep and thick. And as much as gold has been smacked down by a cheeky little test, we've also thinned the sell stack that was above that. And the next time we go back up, which is phase number 2, which can still get pulled back one more time just to the level. So my opinion when this occurred, such was the violence of the thing, I said, we're going to definitely dip back below 2000. And I saw 1960 and 1940. You may have questions on that. How far do you think we'll go? And we're now at 1978 on the live charts. This was, we said some time ago, and inside our community as this was happening. I want to just put it maybe on the monthly, just so that we can see that that was quite a big shooting star. Quite a reasonable shooting star there, and rejection wick. So there has to be a bit of, it's like PTSD. You got a short, sharp slap to the face. You're going to withdraw a little bit. So you got, wow, we had a big reaction this time. But you aren't going to go away forever. You're going to try again. You're going to try again. It's like me with my determination to do cold water submersion. I put my foot in and I go, wow, that's cold. But I've come here to get in, and I'm going to get in anyway. And I'm going to go a little bit further each time, and then I'm going to slowly stay longer as I toughen up. So it's not easy, but you take that ground. So in the 5 stages, what are they? So you get the break and feign back. Then you get what we call the break and second chance. The break and second chance is like the break and feign back, but instead of going right back into your mother's uterus, in sphere, what you actually are doing is you will just move just to the key level. So now you have gone for a second time beyond the 2K mark, and the second repel is not as strong, and it just returns you to support level of around 2000. Now that can be 1999, 1998. You can still technically run it slightly, or it can be 2001. It's not an exact science, but the second attempt will also get rejected, but not as far. We're in the first reject, so we call that second chance, when you get a chance to get a fill in and around the 2K, but not much further. Then the third stage is melt up. That's the stage everybody waits. And whenever you say gold is broken, everybody turns to me and says, oh, but you jinxed it. Look what happened. Gold did break. It doesn't mean, everybody just thinks one stage, melt up stage. And when you're shorting, it's called capitulation. It's just the other way around. Melt up stage is where you typically make all your money. There's 5 stages, and we go through this in our theory. You get pushback when you get key levels, and then eventually you get progress decay once you've made your target, and actually a lot of time elapses and you start to draw down. So there's 5 stages to that breakout, and we are just clearing that first stage. We're going to pull back well within the 2K because we got a short, sharp slap. We didn't lose the fight, but we didn't fancy it. We're not so brave, and we're finding our courage, and we'll come back again. But this time we're a bit more ready for what's coming, and we're going to at least get a left hook off and a kick to the belly, and then we'll run again, because we want to take this guy down. He's tiring, and we keep coming back, and we keep girding our loins and getting stronger and braver. And then the third time we're going to break and properly run for it, and then we've broken the line, and it's going to be open territory. We're running into his farmhouse all the way, and that's the melt up stage. So everybody goes, oh, it's a fail, it's bad news. No, you closed above 2K, you got your rejection, and you're going to go through every single stage before you get melt up. And there's only one more stage for me, but it can take time. This is a monthly chart. You could pull back. We could still be pulling back for most of December. And then you could go quiet, low volatility. Then you make a wind up pattern again. You churn, you chop. It could be March before the second attempt, which will be a bit braver for longer, will happen. And you might only get melt up somewhere in 2024, subject to how and the rate at which this is going. Because this rejection is a big rejection. Technically, you wouldn't ignore that. So you're going to have a full-scale reaction to the pain of that rejection. And that can bring you down still a little bit lower before it calms down. And you also need the volatility. So if I put a volatility indicator, you'll see that the volatility indicator also got very wild. We need the calming to come. So first you have the volatility upside, you get a volatile movement downside, and then it finds its new settlement area where it builds a new base. And this is like climbing Everest. You keep making new bases, but occasionally you go a bit up and you tumble a bit down, and then you calm down, you recover, and you make a new base. This is, in essence, the process we're going through. And everybody just wants melt up. You can't be a crypto kid about a process and expecting instant gratification. It is significant that we broke above 2K. It's also significant that we were well rejected. That means it's not going straight into a melt up, but the melt up stage is inevitable in my view.
Maybe you agree with me. The reason why I think a melt up could happen fundamentally is that if you go back to 2011, we're not too far from where gold was. It was at 1920, I think, the high. And here we are almost 12 years later, and the amount of debt in the system is astronomical. And just to let people understand that in the days of non-fiat currency, for every issuance of currency, you had to have a certain amount of gold to back that currency. So what I'm trying to say here, they've created all this currency out of thin air. And despite that, gold is still pretty much where it was 12 years ago. Some people might say, oh, that's because gold is not money anymore. But believe me, it is. And I think what they've done here with this teacup that's from 2011, it's kind of suppressed it here. And the reason they've suppressed gold is because the higher gold goes, it means that the dollar is worth less and less. So, but I think it's coming to an end, like you said, and the melt up will be, I think pretty epic. When it happens, like you said, it's difficult to say. And for traders, I think the key here is not having that much leverage. For stackers, I think you just keep accumulating and just sit tight and wait, because I personally, I've been waiting since 2002. It's done well since 2002, but I expect a lot more just because of the fact that so much debt is being created. How do you see that, Francis?
It's a very good point, and I want to highlight how events are going to coincide. You've got to be careful about wishing for this gold melt up, because the events that will go hand in hand with that are going to be equally, you get good and bad. As stackers, we really want it, the gold melt up, but within that, we also don't, you've got to understand when we called the debt market turn, which was still in the year of the events of 2020, that no one else was calling. Everyone was going zero rates, negative rates, everything else. You also had a melt up in the gold silver ratio, which was the hyper non-valuation of silver and the general worst cross valuation you've ever had. And you hit 128 on gold and silver ratio. So all major technical events will end up coinciding with a major geopolitical financial crash. So the reason you're not getting your ripping gold right now is because we haven't done the whole debt collapse yet. So yes, you'll be one of the guys happy about the gold market, but you're going to be equally concerned about the cash you had in your bank, your pension that was heavily in debts, bond market instruments at the same time. So it will be a sweetener to everything else that's probably going to be pretty bitter. Because they're going to do the whole problem reaction solution. I mean, it's a bit like me saying, imagine we were bond bulls and we were saying there was a final capitulation going to happen on yields and a final hypervaluation of bonds. You would have been happy that your bond portfolio went up, but you would have been locked down. You would have been given shots. You probably lose a family member and probably have a friend with a turbo cancer, and you wouldn't have had a particularly great time apart from making some money on your bond market, and you would have had that melt up in valuation. So whatever good is going to come of the gold, it's going to be associated. It's only going to be allowed to happen on the event of the absolute systemic failure where they have lost control. So all sorts of other rather unpleasant turbulence will be happening in that time. So we aren't there yet, and that's why we just tested the line and we're in stage one. As much as everybody in the gold space is saying, I can't wait till we get to that third stage Francis is talking about of melt up, let me just say, enjoy your time now while it's not melting up for other reasons, because it is not a nice world that and it's not going to be good breaking news you'll be getting on your CNN if you're tuned into that frequency at all, that's going to be associated with that. And they as sure as hell aren't going to be telling you all about the gold price going up. Occasionally it'll probably make it, and I think they will intervene before you get your full reward, and they may even cancel various markets. Don't forget, if they stop the bond markets from trading, they're not going to leave the gold market open. And if, say, equity markets are crashing and they close the equity markets and say there's huge turbulence, don't forget what happened on 9/11 and the fact that they closed markets. So they don't want the people. So when they game theorize this whole playbook, and as I've highlighted, they've already drilled certain aspects in different countries like Norway for the absolute transparency, like China for the totalitarianism over your freedom and the credit score, like Cyprus for the bank bail-ins. Every single place is a microcosm test center for a certain feature of what we're going to be getting. All the ingredients are tested, and now you're going to get the full soup enchilada for all the major nation states, all served up at once in an absolute smorgasbord of chaos theory that is going to be absolutely upending, utterly confusing, probably be associated with power cuts, mobile networks down, internet networks down, infrequent news forecasts, misinformation designed to confuse you through the broken telephone, then some public information that will be false flaggy and misdirects as well, but of a more formalized nature. It's going to be chaos. You're going to get the full Monty in this. And in that, gold price will go up, and then they might close the markets. It'll start going up, and then there'll just be a black market, supposedly, and you might find totally new price discovery that happens for gold. And everyone will give away their fiat dollars. All the tax avoidance cash that has been hiding under mattresses will all come out, desperate to buy your ounce of gold. And they'll be giving you $10,000 of their hot money to get 1 ounce of your gold, and there'll be no official markets. If they're smart, they would be doing that. And I would expect the Zio thugs with their underlings to be out on the hunt and offering ridiculous things for your gold ounces. And you won't have an official market, and you could have complete lockdown. It sounds a bit zombie apocalypse. It sounds a bit OTT, but you've got to remember, we've already had these things happen. They took down the mobile network for a few hours on 7/7 in London. They closed the stock markets in a number of Western nations during 9/11. They've taken the network down. Both ISPs have to have a kill switch. So you can't get alternative media news. Your man down the road can't broadcast from his YouTube channel what he's seeing, and you won't be able to see it. That's how they monopolize what you get to hear, that you come to believe. So they're not going to make it easy for you, and it will be pretty stark, and they will claim all sorts of incredulous things. So use it to stack. And the best thing that happens is the melt up phase doesn't come tomorrow, because there's holidays I still want to go on. There's properties I still want to buy. There's motorcycles I still want to ride. There's trips to be done. There's living to be done. And I think it could get a little bit tricky during that period. And being rich in gold ounces won't only be the only thing on your mind.
Yeah. And the other thing I would say is that when there is a melt up and the collapse of the debt market and the whole system, you won't want to be holding a GLD or SLV, or, you know, you want to have the real thing here, which I've got here. This is actually a Rothschild gold bar, the enemy's gold. You know, like you said, that, you know, people might come and pay you $10,000 or whatever for it. I think there would be different prices for gold. And someone that is desperate, who had everything in this system and has, you know, collectors motorbikes, they might let you have like 5 motorbikes for an ounce. You know, things are going to get crazy. And I think the silver, which I have some here, that will be for more smaller items. You know, you could go to a farm and get eggs. You could get meat from a farmer, because I think farmers recognize the value of metals. So, Francis, could we finish with silver? Have a look at silver, and what do you think is happening there?
Good idea. Just on the lower time frames before I transition to silver, this is still a little bit of a nasty rejection candle in the orange box. You've got a little bit of a shooting star. I don't think this technically, the gold sell-off is over. And for people engaged in crypto, that's also a bit of a lean on Bitcoin and all the others, because gold is king of the anti-fiat by our framing. And as a result, it was inevitable that digital money was allowed to run a little longer. But once gold went into its second leg of selling, you know, went sideways here in a flag, and then it spilled there.
I saw that earlier today. It actually got up to 1998. And I guess now I'm not watching it right now, but I can see there that
there's further rejection going on here. And we've looked at 1940 at this last low. And we've looked at possibly 1960 as well as levels that could go. So I'm not sure this is over. And the problem you have if you get to 1940 and then bounce is you might have this scenario then
Uh,
You could have a delay. And as I say, more time to stack at cheaper prices. You should view this as a discount window that needs to be exploited, and keep making fiat and converting it into gold ounces. That's the game. Keep making fiat and converting it into gold ounces. That
sounds like a good plan.
yeah, like Rick Rule, actually, he has that framing right. Long may the discount window last. I need more. I need more. By the way, on shares, gold shares will be a multiple of that in upside, and silver shares too, even more so. But the one key proxy warning I want to give everybody that's listening to this is you must secure your share certificates. And most brokers don't apportion share certificates. They get the apportionment in their name, and they proxy say, well, we have enough to cover everybody who claims to hold that silver shares. We have that amount, and you don't own specific shares. So ask for your share certificates. There are a lot of people that have done great work on the legalese. There's many ways they will cheat and deceive you, and the rules that you think are established rules will not apply. It's like the rules of war, treating people with respect, etc. People will rape, plunder, and pillage normal people in that environment, and kill children. You know, you're seeing it going on right now. The rules won't apply. It'll be an absolute fiscal equivalent of a war. And that's when you'll find out all the skullduggery, the proxies, the derivatives, the hypothecations, that have been built into the system. That's when the truth at the full extent of the rot will be exposed that they've been keeping. They've been keeping a real leper hiding behind this beauty queen's makeup. And once you hose it down, you know, you're going to see the sickly state and the sores and the wounds, and you're going to realize it's not something that you thought you could ever have had faith in, and yet you were fooled. So get all your paperwork, on the equities. I want to make that case. So that's looking a bit soft, and I would imagine silver is too. So we'll get silver up to just fully cover on that. And if you'll allow me, I'll also dovetail past the gold silver ratio.
Oh yeah.
Which is kind of handy because there's an interesting technical suggestion in that. So you can see the rejection on silver. Now, the interesting thing with silver is it never made a new high like gold, but it made a significant break. It made a significant break. So I'm going to just clarify that. It also was a seminal break. That is the continuation pattern that we expected to have broken. You can see on my monthly time frame, it's the first close above. Yes, it got absolutely spanked and is still getting spanked at the moment. But it is still that first toe over the line. It's faint joy, but it crossed a triggering event for us in the breakout of this. And how far it goes down, once the volatility dies down and it settles, it will settle higher up, and its next basing point will be from a higher up point next time it attacks. So I expect it to last longer and to be a better break. Let's do that gold silver ratio, because there's an interesting thing that I want to show you. In fact, it might be on this one. Gold silver ratio. Let's just bring it up. This is a little bit of a trick that I'm pulling here. I'm inverting the chart.
All right. Okay.
And the interesting thing is you can check your biases on this. One of the reasons chart inversion is interesting is you check your biases. If you were looking at this, Mario, okay, it's a 3-day. I can stretch it to a weekly.
I guess this is like a silver gold ratio then.
Correct. Yes, it's basically the two. You're quite correct. It's the two components swapped. It's how much of a gold ounce technically 1 bar of silver gets you. But they've used the same scaling, and it just goes the other way. So which direction? If you were just have a, I mean, there's no prize on this, and there's no call. But if you're seeing that chart, what direction do you think? Just off the top of your head, you would see that going in.
Well, that looks like a rising wedge in a falling market. So it would go next, it would go down.
Okay, interesting. You could, of course, be right. You could, of course, be right. If it's at a key point where it has to, don't forget, seeing it in a very negative vein right now over here. If it runs that level, this is where I think your scenario is correct. If we run that low, then we are in trouble, and this gold silver ratio will once again go higher. So going down means the gold silver ratio going higher. So this is a getting higher. The lower you get is getting higher. So we've inverted the chart, remember. So if that breaks to the downside, and for me, it would need to run that low to do that. It's come down very hard. So you're not wrong to say, hey, there's a real risk that it does. And this is why I say it's a very important time right now. We look for 3 impulses in a setup. That's 1, that's 2, and we're in the way of making 3. It depends what it does next, which is going to be interesting. If that breaks down and we break out of this zone, then we will go and probably set new high numbers on the gold silver ratio, and that would mean gold and silver are having a deeper pullback. If at some point this works its way back and breaks out the other side, it's got a lot to do that, and that's why I think you're not wrong with your suggestion. It's got the momentum is currently to the downside. We know that. But
or
if
even sideways, it looks a little bit, doesn't it?
Yes, if we could go sideways and dull and calm down and then stay in the funnel, that's the green and red lines, and then slowly work our way back up.
How do you see it? Because yeah.
So you're right about the current momentum, and it's at a point very close to failure. So what you said is actually correct. You should look at what it's done. This down candle actually had a lot more violence to it than that up, which tends to point to more downside, which is exactly what you said. The point is, it's a key seminal moment for me. I'm less about the view of which direction it goes. I'm more about what's it going to trigger. Because if it breaks to the downside over here, then we've probably got an inversion, and that means gold and silver prices will actually get cheaper, and you're going to get a higher gold silver ratio again. Now that could come on a demand destroying event because silver is quite industrial, and then nobody's using it, no one's buying solar panels, etc., etc. Gold starts to get they do so much disinflation by causing everybody to stop buying. But think March 2020 again, that you will actually get a bid in bonds, and the rates will continue to come down a little bit, and you'll get a period of bonds upward valuation because everybody goes to safety. I think much less so, because after the last bond bull market and the subsequent reaction, I think people are a lot more circumspect, but you could still get one more Pavlovian typical response where money runs into the dollar, into the treasuries, and we have a little bit of emerging market risk, and gold and silver sell off. However, if it doesn't run that and we calm down and we start to come back up, we could be game on for a move in the different direction. So we are close to invalidating and potentially being a bear here, as you pointed out, but I'm watching this, and you'll see I've got alerts here. The minute that alert goes off, then I'm like, okay, gold and silver are getting cheaper. And by the way, that won't be good, I don't think, either for Bitcoin or crypto. So then you're going to get a contraction again, and that points to demand destroying event. That means some sort of narrative starts coming out. It might be geopolitical, it might be banking, financial, but I would think they would quickly pivot it to something else. They don't want too much focus on banking, financial, but it might be a nation state's currency failure, Turkish lira,
Or
Japanese
another disease, or a climate emergency.
climate or pandemic. Yeah, similar state. They might rerun that one. I feel a bit of fatigue has built up on that, but there's no saying, you know, their gall. There's no testing their gall. They might try that one again. So this is a very interesting structure, and I would encourage people to watch it. I'm not saying one thing or the other, but this is going to lead to some form of a breakout. At the moment, it's on the low side, and it had real momentum coming down. But there's a shock reaction to the event of that sell-off in gold. If it continues, this is a downward break. Gold and silver will get cheaper, but it might be hard to buy because a lot of your money would be at risk, and you'll be feeling not very bullish because, like you say, pandemic, loss of work, loss of income, job losses, business closures, those kind of things, geopolitical nerves. When they put you in state of fear, you tend to freeze up and do very little and stop spending. That's your Pavlovian response. That's usually the best time to be buying gold and silver, and it's usually when the price will drop. But unfortunately, you know, people's Pavlovian responses are hard taught and well learned, and very difficult to deprogram. And especially if you've lost money, it's even harder to be bullish and jump in and say, ideal investment time for me to blow some money, when everyone else is clamming up, and you have to be the black sheep in the herd doing exactly the opposite. But that will be the thing that would be most profitable. And it's a bit like buying equities in 2009, peak misery post the subprime collapse, etc., etc. It's easy to talk about how great an idea it was, much harder to actually put it on and feel wealthy when so many things were going on that actually pointed to hunkering down.
Great, Francis. I'd like to thank you for your time, and I'd like to wish you a Merry Christmas and a happy and prosperous New Year.
Thank you very much. And the absolute same to you. Keep up the good work. Keep spreading truth. Love the guests and what you're getting on. Thank you for having me on. And if anybody wants to engage with us, we have a lot of Brits. We have a lot of Americans, North Americans, entirely Canadians as well, and the Commonwealth in our community. Pop over to the Market Sniper YouTube channel, watch our stuff. If you like what we're doing over there, book a call. It's in the first link of any YouTube, and talk to a non-salesman about all we aim to achieve, which in a summary is wealth building and wealth retention in a uniquely attack vector reset environment, which is going to require extra normal game theory thinking. On that point, as an example, I think owning gold alone almost isn't enough. You have to hold it yourself. You have to have some dark gold. You might be required to register it before they come and try confiscate it or charge you a capital gains tax or various other tricks. They know semi-smart people like us will already be doing things like that, and they have a plan for us, Mario. And you have to, and I won't get into the detail, it's maybe a discussion for another day, but you have to deep dive your level of security and what you're thinking about in terms of reset to a whole different level, because they expect the gold bugs to run into gold. They expect new gold bugs to be showing up, and you've really got to take it all away. Get your share certificates if you buy miners and everything else. Thank you to your audience for watching and enjoying, and I'll catch you again next time.
Sure. And to the viewers, I'm going to put links to Francis' YouTube channel and also the Market Sniper website in the description. Take care, Francis, and goodbye.
Bye-bye, Mario. Great chatting.